There is a decision to be taken by equity investors heading into a new week and a new month: buy more stocks ahead of a new bull market, or sell because stocks are just too hot and heading for a fall. Some factors during the coming week, notably US jobs data, a raft of European company results with banks to the fore, and the performance of Chinese stocks after Wednesday's dive may help them decide. But they may simply be swayed by concern that global equity markets have rallied so rapidly and so sharply over the past 4 months that a pause of some kind soon is almost inevitable. Consider the following. MCSI's All-Country World Stock Index has spent the past week hitting a series of New Year highs. It is up close to 55% from its March low. Reuters asset allocation polls for July show global investors have taken their equity holdings back up to levels last seen a fortnight before Lehman Brothers collapse in September. Safe haven cash holdings are at the lowest level since May 2007. Fund tracker EPFR Global says equity funds had net inflows of $9.52 billion in the week to July 27, the highest weekly tally since mid-June of 2008. These kinds of milestones have a number of investors worrying about whether financial markets are getting ahead of themselves. The €160 billion investor Pioneer Investments, for example, has warned that markets are pricing in a rapid return to sustained economic growth rather than a slow recovery from what is a deep recession. More colorfully, Muhammad Al-Irian, the influential chief executive of $842 billion bond fund manager PIMCO, has described equity markets as being on a sugar high. The driver of much of the recent bullishness, which is steering currency, credit and government bond markets as well, is the corporate earnings season, which has been a delight for many equity investors. With slightly more than half of the S&P 500 US stock index having reported, some 76% have beaten expectations and only 14% missed them, according to Thomson Reuters proprietary research. More will come in the week ahead, with European banks particularly in sight. The momentum of positive earnings so far is likely to continue, according to Bob Parker, Vice Chairman of Credit Suisse Asset Management arm, keeping the rally going for at least a while. Valuations are looking overbought, but he thinks further cash will be put into the market over the next few weeks. In the meantime, many investors are still saying that for the kind of risk asset rally that has been underway for the past few months to continue, real signs of global economic recovery will be needed, not just signs that the worst is over. The economic debate in the coming week is almost certain to be dominated by Friday's US non-farm payrolls report, a potential roadblock given that jobs are among the last to improve when economies do and have a large impact on consumer sentiment. The new wrinkle for investors may be China, where stocks have been on a massive rally this year, rising more than 87% from low to high. Last Wednesday, the Shanghai bourse sent ripples around Asian financial markets when fears that major Chinese banks may start restricting loans to cool various booming markets led to a 5% daily tumble. Contagion was generally limited to emerging markets, and the index has rebounded more than 4% in the 2 trading days since. As the poster child for this year's swift market rally, China will be watched closely in the week to come.